Well, welcome back to Simply Money. We're going to be starting here tonight, and we are talking about how to start investing with just $10 a day. And I'm going to ask a question here in a moment, and I want to get us started. Hope everybody had a great holiday yesterday. If you're able to spend time with family and loved ones, it was great for me. I had a great time spending time with my boys, my daughter in law, my wife, and my grandbaby. So it was a great time. I always look forward to that. So tonight's topic is how to get started investing with just $10 a day. So if you've never done any kind of investment calculators, we're going to be looking at some of that. We're going to actually use a Monte Carlo simulation because it not only can look at how long your money will last in retirement, but it can also help forecast what your money will grow to depending on how you're invested. So we're going to be looking at that. If you've never used a Monte Carlo, it'll be a great opportunity for you to see that, how it works, and how robust it can be. And we're going to look at some other things. We're going to look at different uh, places that you can get started investing as well. So let's go ahead and dive in here. And as you come on, just go ahead and drop a like or a heart in the chat so we know you're here and we can welcome you. And I know it's the holiday, so we expect that we will have people uh, coming in later or not coming in at all this week as we get started. This is fresh for everyone, so I know it's going to take time to get used to that. So, the topic today again is how to start investing with just $10 a day. Did you know you could become a millionaire by investing $10 a day? And I know it may seem like, oh, that's a, you know, hook or uh, clickbait that you're using, but it's really not. A lot of people don't realize how starting small with investing can grow into a large amount. It can catapult your savings, it can catapult your investments. And we're going to look at that. We're going to use some scenarios. And I'm just using $10 a day as a starting point. And we want to really focus on what difference it can make starting early. Like I even have a friend who was talking about having his kids on here, or young teens, having them start investing, which I think is a fantastic idea because you're adding an extra 10 years of compounding. So the amount that you need is even smaller for that impact when you become, 55, 65 years old, because those extra 10 years make such an extreme difference in the compounding power. So we're going to be looking at that. And we're using $10 as a starting point. And you may start with $10 a day. You may start with a dollar a day. Maybe that's all you can scrounge up to invest at this point, and that's okay. We're going to look and see how the amount isn't really what we're going to be focusing on. It's the discipline and the different things going on with that. So let's look at this in a couple different ways. And so I just again want to welcome you to Simply Money. We are here to help people achieve their financial goals. We talk about savings, we talk about debt payoff. We're doing a video tomorrow. It won't be live, but I'll be working on a video on sharing my top 5 ETFs and why they're my favorites. And this isn't to get you to go and do what I'm doing, it's just to share kind of the methodology that I use and the reasoning behind what I'm doing. So we have some great things that we'll be doing and hope that you'll get to enjoy those. But today, again, we're talking about how to get started investing with small amounts because a lot of people hold back. They think, well, I'm going to wait. Let's say you want to buy, Apple and it's a couple $100s. I don't even know what Apple is. I don't buy single stocks, but let's just say it's $200 and you say, well, I'm going to wait till I have $200. Then I'll buy a share of Apple. And the great thing about this is we're going to talk about fractional shares and how you can buy, a quarter of a share or a tenth of a share or a hundredth of a tenth of a share. It doesn't matter because those all add up as you just start putting in money consistently, small amounts, dollar cost averaging, daily, weekly, monthly, however you're doing your investing, and you invest that amount. So $10 a day basically works out to $300 a month, give or take a few dollars. So we'll just round numbers off throughout this. $10 a day, $300 a month are the numbers we're going to be using and talking about, and how you can get started on that in your investment journey. So let's just start with the basic math. If you invest $10 a day on an average 8% annual return, and we're going to look at a Monte Carlo here in a minute and see some various returns that you could be getting, and you invested that for 30 years, you'll have about $450,000. Not bad for $10 a day. But if you were able to start 10 years earlier, you saved that and invested that for 40 years, now you're talking over $1 million. See how 10 years makes a huge difference. It doubled the amount of money. So investing $10 a day for 30 years get you about half $1 million, just shy, $450,000. But if you had an extra 10 years, and so for my friend wanting to get his kids involved, that extra 10 years could make the difference of a half $1 million. That is huge. Now, I don't know what his plans are. I don't know that he's going to go have his teenage kids investing $300 a month. But the point is that 10 extra years doubled the amount. 30 years, you get a half a million. In 40 years, you get a million. So that last 10 years, you doubled the amount that you invested. And that's typically what it is about 10 years to double your money using the rule of 72. If you've never read about or understood the rule of 72, it's basically if you take the number 72, you have to have your interest rate and the number of years that you save. And if that, when that equals 72, your money has doubled. So the higher interest rate you have, the fewer years you need. You know, if you have a lower interest rate, then you need many more years to double your money. So again, this is why having a good solid investment that does bring and a good return can help you double your money even quicker. But we don't want to try gambling it and trying to get these super high returns and blowing things. So again, that's just some simple numbers to look at. So the next thing I want to talk about before we go into some of the charts is that you need to find a place to invest. And I recommend index funds and ETFs. An ETF like SPY or SCHD. And again, these would have to get in this for those who aren't familiar with this in a whole nother video on what they are and how they work and the difference of these different ETFs. And it's not as simple as just I'm going to go get an ETF and I'm set, because ETFs can be just as volatile, if not more so, than a single stock. If you go and get something like Procter and Gamble or Johnson and Johnson, those or Coca-Cola, those are very established companies. They're not super high risk. You're not going to get huge returns. It's just nice and steady. But you could go into an ETF that's super high volatility, and maybe it's all high tech stuff, up and coming tech stuff. So just because you're diversified doesn't mean that you're diversified well. And so we need to look at that and get into understanding how that works in another video. But for today, we're just going to talk about investing in ETFs. I'm going to use a couple examples. And then you also have to find a place to invest that will allow you to invest in fractional shares, so you don't have to wait until you have $200 or $300 saved. You can invest $10 or $5, and each app has different investment amounts that as a minimum, and we'll look at a few of those. But we want to keep it simple and relatable for everybody. If you're a seasoned investor and you understand different things, that's fine. Maybe this isn't for you. Maybe you can help throw some comments for others and provide them insight on what they can be doing, and give your input of what you've done that's been successful. So that is kind of where we're at right now. I want to share my screen here. Let me find that real quick. Let's see. Share screen. Okay, it's not going to let me right now. That may have to work on that here. Those who are coming in, I appreciate you that have popped in. I know some people are not going to make it tonight that said they would. That's okay. We'll get you next time. Okay, where'd you go? I apologize. This is not working quite like I had expected it to, but those are technical difficulties. Let's try this one more time. Okay, so we're going to bypass sharing the screen right now. Not sure what's going on, why this isn't working. Let's see. There it is. Get it? All right. Hopefully you can see this. So here's the Monte Carlo. Again, I apologize for that delay there. So Monte Carlo is just a way of doing different simulations. And what I'm going to show you here real quick is I'm going to put in initial $1 amount. We're going to put in $300 contribution every month, and we're going to do this for 4 years. I've already filled out all this. It's in here. And what we're investing in this scenario is VTI, the Vanguard Total Stock Market. This is an ETF that comprises about 4,500 different companies. So you are well diversified. You own a little piece of everything in the stock market. It is a highly diversified uh, ETF, super simple. You don't have to worry about if you're in all the sectors and the right sectors. It's a great way to get started until you learn more, and then maybe you want to diversify differently and have more specific ETFs. But a total or broad market index is a great way to get started because it exposes you to a wide variety and you get that long-term growth as well. So here's the scenario. We run this simulation and it's going to take investing $300 a month for the 40 years and show us various levels of returns based on past performance. Now, obviously, the future isn't going to hold exactly true to the past, but if you take 100 years of the stock market's history, the odds are the future will look very similar in a 30 and 40-year period. But they show you the 10 percentile, 25th, 50th, 75th, and 90th percentile. So you can see if it varies according to various 30 and 40-year returns in the past, if it has the similar returns in the future, where you'd fall in those percentiles. So here's the bottom line is the chart here just shows us the different percentiles. So we're going to start with the 40 years. If you were to invest $10 a day for 40 years and you got the 10th percentile, meaning only 10% did worse than this throughout the history of the stock market, you would end up, as you can see here, 10th percentile with $654,000. So you didn't reach the million that we said because you didn't get the 8% return. Again, that is historically doing worse than it's ever done 10% of the time. We're going to look at the 25th percentile because that's more uh, feasible. Actually, 25th to 50th is kind of where I always do my projections when I'm projecting growth or when I'm projecting how long will my retirement savings last. I like using those. I obviously don't go to the 90th percentile because only 10% historically have done that or better. So I'm not going to go on those odds. I like what's the median? What's the just below the median? Let's go with that and see how it pans out. As you can see, if you were to invest $10 a day in VTI for 40 years, you'd end up with $1 million to almost $2 million in those two percentiles. You could maybe you get lucky. Maybe the next 40 years are the best 40 years the stock market's seen. You end up with the 5 million. Again, I don't do the long shot type thing. That's why I don't day trade. That's why I don't look for the shortcut on the investments. It's slow and steady. But and likewise, if you have the worst 40 years, okay, fine. You're like, oh, that's only $654,000. When was the last time you looked at your bank and said, oh, shoot, there's only $654,000 in there? That is, again, a bad scenario. And you still end up with almost $750,000. Not too shabby. So this is just a simple thing we can use to get an idea of how different funds perform in the past and how that would translate into the future. I want to show you one other that I'm going to be sharing with you in a moment. Instead of VTI, we're going to use SCHB, which is Schwab's Broad Market Index. So SCHB, and it's just different makeup. I think there's 2,500 companies in there, and we'll look at the chart in a minute to verify that. It's not as many, it's not diversified as widely. It's a little more concentrated, but it's still a very diverse fund with lots of different companies in there. As you can see on this one, at 40 years on the 10th percentile, you're at $2 million. That's because SHB has averaged way more than the 8% over its lifetime. So we want to look at this. Again, this is a very high uh, amount, but and it's for 40 years. So if you're 25 years old and you start and you go until you're 65, this is what it's looking like. So let's go down to 30 years. Look at the difference here. 40 years, you're looking at $2 million. We'll just round it off. At 30 years, you're at 682,000. We're looking at the 10th percentile on this one, the very bottom number there. See how that extra 10 years. So instead of, let's say you're 35 and you start investing until you're 65, versus if you're 25, the 25-year-old ends up with 1.4 million more dollars from that 10 years. That is a great compounding illustration how that 10 years really made a difference. So I'm going to go ahead and close that out for now. We're going to stop sharing screen. And this is just, again, us looking at how to invest and how that translates into the growth. So, the first thing you need to do as you get ready to do this is change your mindset, because it's not about how much you start with. It's about building the habit of investing and just being consistent. Don't wait until I hear, well, I don't have enough money to invest. Start small. Find something you can cut out in your life, something simple, something insignificant that you can say, you know what, I'm not going to indulge in this. I'm going to put this aside and I am going to invest this because I want to see that compounding over long term. And what we talk about on this channel all the time is if you can get yourself out of debt, you get rid of credit cards, you get rid of car payments, eventually you get rid of your mortgage. And that takes time. This isn't something you're going to be able to go get rid of tomorrow just because you want to. It takes time and discipline. But when you do, then you have all that money that you can be investing. And talk about, you think $10 a day grows fast, $300 a month. Try putting 2,000, 3,000, 4,000, depending what all your debt is. Imagine investing all that and imagine how fast that grows and compounds because you've gotten rid of those expenses. So that is one of the things we want to help you do, is change your mindset as you work toward these goals. So some tips to get started. First, automate your investments. All the banks, all the platforms have automatic investments that you can set up. I have it to where my paycheck, I get my company's 401k match. Boom, that's done. My paycheck hits my bank. Before I even see it, I have money going out to my Roth, to my wife's Roth. I have money going out to our HSA. I have money going into other investment accounts. And I don't even see it. I have money that goes automatically into our high yield savings. And then I have my checking account that I'm using for my budgeting. And the budgeting is what I use for my day to day, month to month expenses. But I don't see it. So automate it. It's done. Pay yourself first. Make it a priority to pay yourself before you pay anything else. Pay your future self. Make that a high priority in your life. Two is cut out some small expenses to fund your daily $10. If you're not able to come up with $300 a month, I challenge you to get on your budget. If you haven't done your budget, check out some of the videos we have on the website, on the channel, and get going on a budget and find some ways to cut out some expenses. Maybe it's cutting out one streaming service. Maybe it's cutting out a subscription you don't use. Maybe it's cutting out eating once a week or whatever the case might be. And get that $10 a day and begin to invest it. Begin to put that into those funds, whatever one you pick, and let them accumulate. It's going to seem so insignificant at first. Month one, you have $300. Month two, you have $600. So slow. And it just seems like I'm never going to get there. But be patient, be disciplined, be consistent, and you will get there. And the number 3 is to avoid the common mistakes like chasing hot stocks. Don't pay attention to the news where they're like, "Oh, this is the new stock. It's gonna, you know, 200% growth or 2000% growth this year," and chasing those high returns to try to shortcut this. You might get lucky. Yes, you might be one of those 1 in a million people, 1 in 10 million people, whatever the odds might be. Those are the ones you hear about, but you're not hearing about the hundreds of thousands of people who have gone broke. I just did a video, it'll be posting sometime down the road on day trading, people who are trying to trade and time the market and get the buy in the lows and sell on the highs. And they don't take into consideration the stress, the tax implications, any of that. But 90% of people that do that lose money because they're not in it for the long term. They're taking chances. They're trying to chase the hot stock of the day, whatever, Yahoo Finance or whatever show you watch is promoting. The news loves this and they promote this. And that's not how you're going to build wealth. You're going to build wealth by being disciplined and being consistent. So automate your investments, cut out some small expenses to fund your investments and get that $10 a day. Once you hit that, then you can work on some other things. And 3, avoid common mistakes. So, question: what is stopping you from investing today? What, like, if I was to ask you right now, what is stopping you from investing today? And that would be a question I would ask anybody. If they say, I'm not investing, and you need to ask yourself, throw it in the comments. What's stopping you from investing? Is it too much debt? Is it lifestyle creep? What is stopping you from investing? I'd be curious what others are struggling with. We want to help everybody reach their financial goals, and that's only going to happen as we make some commitments in this. So, I encourage you to to take those steps. Get started today. So, we're going to close there. So, I want to show you a couple things. Well, I'm not gonna show you this. I'll just share it with you over verbally here. If you don't have somewhere to invest, especially if they don't have fractional investments, meaning you have to buy an entire share. So your fund will hold the cash until you have enough to buy one complete share. And if you have 10 extra dollars or 20 extra dollars, it'll hold that until you have enough to buy another whole share. But a lot of the platforms like Robinhood, Fidelity, Schwab, one of my favorites, M1 Finance, allow fractional shares to be purchased. So you can go ahead and put $10 in and say you want to buy SCHB or VTI, whatever you choose. You don't have to wait until you have enough to buy a full share. It'll buy whatever fraction of a share that $10 would buy. And then when you put your next $10 in, it just automatically buys it. So you're not having to wait and accumulate, and you just feel like you're getting started early. And that's really important for beginners, I believe. I like it even now. I have money going in. I don't usually have to worry about fractional, but I just like the fact that if I want to throw an extra 20 bucks in, I can throw 20 bucks in. I don't have to wait until I have, $200 or whatever the share is selling for. So look at some of these different options again, like Robinhood, Fidelity, Schwab, M1. There's some others out there, but these are great. Robinhood's really good for beginners, but again, I like M1. This is me. I'm not saying to use this, but M1 because it automatically creates my portfolio for me the way I like it, balances it, uh, balances it anytime I want it to. It's a really cool visual, my favorite, but you have to find what works for you. And there can be some charges on those if you don't have enough money in them. So again, I'd look at somewhere like Robinhood or Fidelity or Schwab and get started with those. So what again, last time I'm going to ask, what is keeping you from investing? What is something that keeps you from getting started? Look into uh, ETFs that are well diversified. I want to share the ones I was looking at, and give you the accurate information now that I have the sheet in front of me. VTI has 4,000 approximately different companies. It's well diversified, where SCHB again has 2,500, give or take. So they're both very diversified. Uh, SCHB is going to be a little more volatile, meaning it will have a little bit higher, as we saw in the Monte Carlo, has a much higher upside, but when it goes down, it will probably go down a little harder than VTI. But those, if you're in this for long term, that shouldn't bother you. When you see those valleys in your stocks and your investments, you have to get the mentality that it's okay and not panic, because that is actually good, because the next time you buy, the next time you put that $10 in, that $300 in, whatever you're putting in, if it's down, you're getting more shares during that period. And then when it's really high, you're getting fewer shares. And long term, it's going to be up. You're going to gain money. It's not going to be something you have to worry about. They say after 10 years, the odds of losing money in the stock market, and again, this is diversified, don't take this out of context. I can go buy one stock and I can lose money if I hold it for 50 years. But if I'm diversified and I'm in like VTI, the entire stock market, after 10 years, your odds of losing money are zero. Not that it won't dip, but let's say you put in $10,000 in 10 years, you're so far above, you're probably at 20, $30,000. You're not going to dip below that 10,000 because you have passed that point of no return in the investment where it's built that power. Now, and this is where people get confused. They look and like the other day, the stock market dropped about 3% in one day, and that's a huge drop in one day, but it came back. But you didn't lose your initial investment, especially if you've been in it 10 years or longer, because it's gone way past what you've initially invested. And so people are really accustomed to looking at the stock market and saying, oh, I'm losing money. No, you're not losing a thing if you stay put and don't sell it. When you sell it, you locked it in, you're done. You can't regain that loss. You may reinvest again, but you're not going to get back into where you lost the money. So don't allow ups and downs to keep you from investing. Investments in the stock market are like a roller coaster. And again, I've shared a lot of stuff on my channel about Dave Ramsey. Is one of the people that I do follow. I like a lot of his stuff, especially on debt, payoff, and how to get out of debt. But one of his sayings I really like is the only people that get hurt on a roller coaster are those who jump off. And the stock market's the same way. The people that lose their shirt are those who jump off every time it gets scary. And then they buy in when they're going up the exciting, remember that on the roller coaster, that first hill, it's so click, 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 click. It's so exciting, anticipation. And then you start losing your stomach as it goes down. It hits those turns, and that's how the stock market is. A lot of people get really weary and scared, and they start jumping off. And you can't do that. That is the biggest thing. If you're young, you got plenty of time to ride this out. If you're older, that's where you need to start learning how to be diversified and hedged. And we'll get into that in some other videos on how to hedge to where you're not getting those big drops or not as big of drops. So it helps protect you a little bit. So that is it on today's topic on how to start investing with just $10 a day and what that can look like. Again, for those that missed it, rewatch this once it's posted. $10 a day in VTI for 30 years, you're looking at about $400,000, and 40 years, you're looking at about $1 million. And that's just simple, easy, not have to worry about it investments. Not telling you to invest in VTI, just use that as an example. So, Galley boy, I see you there. Sorry, I've been just going. I had a couple other people I expected here. They emailed me, said they weren't going to be able to make it. It's okay. I'm doing these live, whether anybody shows up or not, and we'll just keep plowing through. Um, you missed almost everything, though, buddy. But you'll have to watch it after. You can watch me stumble through. Does anybody have any questions? We got a few minutes. We can do some comments, some questions, Q&A, and I'd be glad to answer that. If not, I'm going to go ahead and close it out. I'll give it a couple seconds here. I really like doing the different scenarios. If you've never used a Monte Carlo simulation, they're really good. They're a little more robust than just a regular investment calculator where you plug in, okay, I have $10,000. I'm going to put $300 a month and I'm going to expect 7% return. How much money will I have in 10 years, 20 years? The Monte Carlo allows you to use various stocks or ETFs or even sectors. There's lots of things. If you'd like to learn more about a Monte Carlo simulation, we can do a whole video on that. Just leave a comment, not just here in the live, but those that watch this after. If you'd like to see a live video on the Monte Carlo, I'd be glad to do that. But they're great, robust tools so you can see different things and how they work and how it can grow your money. All right, we're going to close it up. I appreciate you joining us, and we'll see you next time on Simply Money.